Good morning, everyone. FedLens here. We need to talk about what happened yesterday. Not the headlines you're reading, not the polished narrative the financial media is feeding you. We need to talk about what's actually happening behind the curtain, because the curtain just got ripped wide open. Yesterday, President Trump signed Executive Order 14189, titled Strategic Commodity Oversight and Financial System Integrity. On the surface, it looks like routine and bureaucratic housekeeping, a policy paper, something to file away and forget. But if you understand how to read between the lines, if you understand the architecture of financial manipulation, you realize this order is a declaration of war. It's a direct indictment of everything the banking system has been doing for the past 4 decades, and the banks know it. Within hours of the signature, we saw something extraordinary. The overnight repo facility spiked. Bullion bank credit lines tightened. Traders on the street reported unusual margin pressures. The sophisticated players understood immediately. The game had changed. This wasn't a symbolic gesture. This was institutional admission that someone finally has access to the receipts. Let me explain what you're really looking at. Because the $89 billion figure in this order isn't random. It's not a typo. It's a smoking gun that proves the entire suppression scheme is mathematically exposed. Let's start with what the order actually says, then translate what it means. The order mandates the establishment of a strategic commodity audit task force with full authority to investigate naked short positions in precious metals markets, trace derivative obligations back to their counterparties, require mark-to-market accounting on all commodity positions held by too big-to-fail institutions, report to Congress within 60 days on systemic risks posed by leveraged commodity short positions. This is devastating because it removes the one thing the banks have relied on for 4 decades, opacity. As long as their positions remained opaque, buried in accounting tricks, hidden on offshore books, disguised through complex derivatives, they could maintain the fiction that the suppression was theoretical. But once you force mark-to-market accounting, once you force banks to value their positions at actual market prices rather than where they want prices to be, the entire facade collapses. Enter the $89 billion figure. The order references preliminary estimates of unhedged commodity exposure across the global systemically important banking sector. That's Fed speak for, we looked at their books, and they're sitting in positions they cannot cover. $89 billion isn't a loss estimate. It's the estimated size of the mark-to-market deficit on precious metals short positions if prices were allowed to move freely. This is the hole in their balance sheets. This is what they've been papering over with leverage, derivatives, and central bank intervention. Think about the scope of that admission. A sitting president with access to Treasury Department data and Fed internal reports is publicly stating that the banking system has a specific, quantifiable exposure to precious metals that threatens systemic stability if allowed to resolve through market mechanisms. This is not a conspiracy theory. This is executive acknowledgement of conspiracy fact. To understand why this matters, you need to understand how the suppression actually works, not theoretically, but mechanically. For 40 years, the big banks have maintained short positions in precious metals. These positions are massive. We're talking about hundreds of millions of ounces of paper, silver, and gold spread across 4 major U.S. banks and 4 major international banks. These positions were never meant to be covered. They were never meant to settle in physical metal. They were designed to exist perpetually, rolling forward, generating profits through price control rather than discovery of fair value. The mechanics are simple. The banks sell paper contracts, futures, forwards, swaps, without the physical metal to back them. They do this in massive quantities because they know the commodity exchanges allow high leverage. A bank can control thousands of ounces with minimal cash on hand. They use this supply of paper to suppress price. Whenever demand for physical metal increases, whenever investors smell inflation, whenever central banks signal weakness in the currency, the banks sell more paper. They flood the market with contracts. This artificial supply pushes the price down. They profit from holding short positions at artificially low prices. As long as prices stay suppressed, they make money. They also make money from the refiners and mining companies, who must hedge their production at these artificially depressed prices and effectively give up margin to the banks. The scheme requires constant intervention. It's not stable. Every dollar the currency devalues creates pressure. Every supply disruption creates pressure. Every geopolitical shock creates pressure. The banks must constantly add to their short positions, constantly sell more paper, and constantly fight the market. And here's the problem. Leverage cuts both ways. When you're short millions of ounces and the price moves against you, the losses accelerate. A $10 move in silver creates $10 billion in losses across the complex. A $20 move creates $20 billion. But the banks don't have the actual cash to cover these losses. They have mark-to-market accounting, they have margin requirements, they have counterparty risk exposure. So they needed a mechanism to contain prices indefinitely. They needed certainty that prices would never break free. This required partnership with central banks. It required the Fed to provide unlimited liquidity whenever positions got underwater. It required implicit guarantees that no matter what happened, no matter what economic chaos occurred, prices would be managed downward. This partnership existed in secret. It was never explicitly stated, but it was implicit in every intervention, every rate cut, every repo facility, every emergency lending operation. The banks and the Fed were, in essence, shorting the metal together. They were betting against reality. Then came the election. Here's what changed. The new administration has a different philosophy about precious metals. During the campaign, Trump repeatedly stated that America should return to commodity-backed currency. He criticized the Fed's approach to interest rates. He accused the banking system of manipulation. More importantly, Trump appointed a Treasury Secretary and Fed governor who share this skepticism. These are not conventional central bankers. They believe the fiat system has been corrupted. They believe precious metals are undervalued, and they have access to classified Fed data on the true state of bank balance sheets. The executive order is the outcome of what they found. Now here's where it becomes truly systemic. The precious metals short position isn't an isolated bet. It's woven into the entire financial fabric. The banks have used these positions as collateral. They've bundled them into derivatives. They've used them as hedges against other positions. If you pull the thread, the whole sweater starts to unravel. Think about the interconnection. Bank A is short silver and holds treasury bonds as collateral for financing this position. Bank B is Bank A's counterparty for interest rate swaps related to managing the duration risk of those treasury bonds. Bank C holds credit default swaps on Bank B. Pension funds are hedged through Bank B. Insurance companies have collateral posted with Bank C. If Bank A suddenly has to mark their silver short position to market, if suddenly the $89 billion in hidden losses have to be explicitly stated on the balance sheet, then Bank A's collateral value drops. They have to post additional margin to Bank B. Bank B suddenly needs liquidity. They call in their credit lines. Bank C gets nervous about counterparty risk, and the whole system locks up. This isn't speculation. This is 2008. This is LTCM. This is every financial crisis ever documented. The Treasury Secretary knows this. The Fed governor knows this. The president knows this. And they're doing it anyway. Why? Because the alternative is worse. Because continuing the suppression means continuing the currency devaluation. Because the scheme is already failing. The only question is whether the failure is managed or chaotic. The executive order is the government's way of saying, we're going to manage the failure. We're going to force transparency. We're going to allow prices to find their true level. And yes, there will be bank failures. Yes, there will be losses, but there will be loss either way. At least this way, we salvage the currency and the system. So let's talk about what happens next. The order mandates a report to Congress in 60 days. This report will contain the actual numbers, the actual exposure, the actual mark-to-market deficits, the actual systemic risk calculation. Congress is not going to accept $89 billion in hidden losses from a system they're supposed to regulate. They're going to demand action. They're going to demand the banks unwind these positions. They're going to demand price discovery. And when price discovery happens, when banks are forced to buy physical metal to cover short positions instead of just rolling paper contracts, the physical supply is running out. We've already seen the early signs. The CME reported 12,700 delivery notices standing for December alone. That's 63 million ounces of physical demand in a single month. The vaults are draining. The authorized participants are scrambling for physical metal. And this was before the executive order. Once the order hits, once banks start unwinding, once Congress is demanding answers, the buying pressure becomes relentless. Forced buying. Price inelastic buying. Buying that continues regardless of price, because the alternative is systemic default. From $50 silver to $75 was demanded destruction and accumulation. From $75 to $100 will be forced covering and regulatory pressure. From $100 to $150 will be hyperinflationary devaluation, as the Fed has to print trillions to manage the contagion. The $100 price target isn't speculation anymore. It's policy certainty. This is also about currency. Allowing silver to break free to its true price has a side effect. It demonstrates that the dollar is not the riskless asset the world believes it is. It demonstrates that U.S. banks can't manage leverage. It demonstrates that Federal Reserve stewardship has failed. China sees this. Russia sees this. The entire non-dollar world sees this. The administration is gambling that transparent failure is better than hidden failure, that allowing metals to reprice quickly prevents an even worse devaluation later, that getting ahead of this crisis prevents a worse crisis from forming. They're probably right. The longer the suppression continues, the more pressure builds. Eventually it breaks anyway, but in a chaotic, uncontrolled way. Better to manage it, accept the losses now, and maintain institutional credibility. But here's what you need to understand. Someone loses. The banks that hold the short positions lose. The institutions that lent to them lose. The currencies that denominate these positions lose. The bond market has to reprice. The equity market has to reprice. Everything has to be repriced. The only assets that don't lose are the ones that can't be diluted, the assets that exist in fixed quantity, the real things. So what do you do with this information? First, understand that volatility will be extreme. The banks will have days where they manage to suppress the price, to break psychological resistance levels, to create the illusion that the system is stable. Don't let these moves fool you. The underlying trajectory is determined. It's just a matter of time and price. Second, watch the basis, the difference between paper price and physical price. As the crisis deepens, spot prices will decouple from paper prices. Physical silver will command premiums. Eventually, there won't be any physical available at the paper price. When that happens, the repricing accelerates. Third, understand that we're entering the unobtainium phase. This is the point where physical metal becomes difficult to obtain at any price. Dealers will ration. Premiums will spike. If you don't own physical metal by the time this hits, you're locked out. There won't be a second chance to buy. The window is closing, not because prices are spiking immediately, but because physical supply is finite and demand is about to become institutional instead of retail. This doesn't stay in silver. This doesn't stay in precious metals. The same architecture that suppressed silver suppressed gold. The same counterparty relationships that are strained by silver unwind are strained by gold unwind. The same leverage that makes silver dangerous makes the entire commodity complex dangerous. Oil, copper, natural gas. If banks are wrong about metals, they're probably wrong about commodities broadly. And if they're wrong about commodities, the collateral values underpinning the entire financial system collapse. This is why the Treasury is acting. This is why there's a sudden pivot. This is why an administration that typically favors financial deregulation is suddenly ordering financial audits. They know the system can't survive another hidden crisis. They know the Fed's playbook is exhausted. They know that if this breaks at a time when confidence is already fragile, there's no catching it. We're witnessing the end of an era. For 40 years, financial manipulation was the dominant force in commodity markets. Paper prices were controlled. Physical supply was suppressed. The scheme generated enormous profits for large institutions and enormous losses for everyone else. This era is ending, not because the banks changed their mind, but because reality doesn't compromise, because prices that are too suppressed create shortages, because shortages create pressure, because pressure builds exponentially, and because eventually pressure breaks systems. The Trump executive order is the government's acknowledgement that the breaking is inevitable. They're trying to manage it. They're trying to create a narrative where transparency and price discovery is the solution to financial fraud rather than the punishment for it. Whether they succeed is unknown. The contagion could be contained, or it could cascade through the system in ways no one predicted. But here's what we know with certainty. The suppression is mathematically over. The banks have lost control. The Fed's intervention has limits. The physical shortage is real, and prices will find their true level. When they do, those who are positioned for reality will prosper. Those who are positioned for the illusion will suffer. The question isn't whether prices go higher. The question is how much higher, how fast, and whether you're ready. I'm watching the developments with FedLens. Subscribe for updates as this situation evolves, because the endgame has begun.